breakdown followed by a market structure shift, which I believe we got over here. This is now our market structure shift. This is a golden A+ setup, right? We've also left some inefficiencies or fair value gaps within this region as well. And we are below the weekly opening price because this is a weekly candle, right? This is the weekly opening price over here. But I want traders to screenshot this in their brains and keep this, right? We're below the weekly opening price. We're below the daily opening for the day. We've taken out a previous day low and we've broken structure. If you can use these simple concepts, these simple mechanical rules in your trading, there's no reason why you can't have a strike rate. 100% some weeks, 80, 90% some weeks, right? These are the mechanical rules I teach within Price Action Labs that you can apply to NQ, ES, US 30, or just about any other market you want to trade, right? This is how the market works. Liquidity to fair value gap, liquidity to fair value gap, paired in with PD arrays, understanding time and price. Time and price is simply buying below an opening or selling above an opening. That's all you need to understand. So if we just play price on, we actually get a mitigation onto the next coming day. So this is now Wednesday. So again, we have our weekly candle, which of course is very bullish, but we have our weekly opening in this region. So what we are looking for now, again, notice how price comes into this level and we had a fair value gap over here. Another question I often get is how can we grade fair value gaps, right? This is a fair value gap over here. How can we grade high probability fair value gaps? How do we know which are high probability, which are low probability? Well, it comes down to what I've told you. Next time you see a fair value gap in price, you want to look for the following things. You want to see a market structure shift to qualify the direction. You want to see where you are in line with the weekly opening price. So I'll just write WO for short. And you want to see if it's swept liquidity, i.e. a previous day low is your best friend to start off with. If you have these three things and you're below the weekly opening, there's no reason why you can't take a long trade, right? So again, a safe stop loss would be just below the Judah swing, the weekly Judah swing. You can have it slightly above if you want to be a bit more aggressive. And from here, your first initial target would be just the high from Wednesday. But if we look left, we understand price takes out Asian. We got some Asian liquidity over here. We got some previous day liquidities from Friday. Quick pro tip about liquidity is that liquidity from Friday will often be swept the previous week or targeted the previous week, right? So this is a 1 to 2 trade on NASDAQ, right? So of course we had some, I call it squeaky butt time, really. We came into our entry. It wasn't necessarily the fastest trade to get going, but as you can see, price did eventually give us our expansion to the upside. I believe we got our expansion to the upside, right? What I want traders to understand also is that we had a re-entry over here. We had re-entries here, we had re-entries here off this fair value gap. But what makes this fair value gap so high probability is this price action over here paired in with this line over here. So my analysis is very rudimentary, it's very basic, it's very mechanical. And the reason I stress mechanical processes is that they allow you to trade as a robot, which will then decrease your emotional volatility. This is a classic NQ example you could have taken, right? This is a very, very classic NQ trade you could have taken. Now, of course, in line with the higher time frames, which are bullish, this trade did work out. Yes, I understand the stop loss is a bit wide, but this trade is mainly about the higher time frame buyers. So why could you have taken